Welcome to Short View Trading. It's Monday, 17th of July. Now, if you want to trade these markets on a 1 to 2 week basis, if you're a swing trader of equity index futures like S&P futures, FTSE, NASDAQ and similar, what matters? What factors do you need to look at? How should you go about trading markets on that short-term 1 to 2 week time frame? That's what we're going to dig into in this video. Well, it's been a remarkably resilient stock market, especially in the US, where we see a new multi-month closing and intraday highs from both the S&P 500 index and the NASDAQ 100. With those markets rallying in mid-June into early July, despite a number of sell signals on our short and medium-term market timing models. Short-term is 1 to 2 week time frame and the medium-term is multi-month. So despite those sell signals, the market pushed on through, literally wobbled a couple of times for a few trading sessions and then started rallying again, demonstrating that resilience. And as you can see from the chart we're putting up in front of you now, the S&P 500 has been trading at the top end of its uptrend channel that's been in place since early October. So resilient US markets, impressive price action, behaving very well in that context despite those sell signals as mentioned. But there are two big caveats. And the first one is if you look at the dollar, as of late, the dollar's broken below key support levels and been really quite weak in the last week or two of trading. A weak currency, of course, supports an equity market as it allows it to rally more as its imported earnings become worth more in the domestic currency in the US dollars, and therefore supporting the stock market as they support that earnings outlook with a weaker currency. So there's an old saying in stock markets that you want to look at the stock market with a strong currency to find out the real trend in stock markets. And that leads us to the second caveat. The second caveat is the idea that outside of the US, markets have struggled. Markets are not making new intraday and local closing highs. They've been range bound for several months, and indeed some of them even trending mildly lower rather than just simply sideways in that range bound formation. Just take a look at some charts we're going to put up in front of you now. First of all, the Euro Stoxx broad index. This looks across the Eurozone countries, looks at several hundred single stocks in the index, probably about 450, 100, something like that. It's a subset of the European broad index, so as a Eurozone only version of it. And you can see it's been sideways range bound since earlier this year, pretty much for the last 6 months. So no sense of making new multi-month highs in Europe. Same point if you look at the DAX, again, range bound as it has been in the Euro stocks for the last few months. Or look over the waters at the UK, FTSE 100, same sort of pattern. Or equally, if you go over towards Asia, you look at China, the Shanghai Composite sitting on its 200-day moving average, tracking sideways, no upside momentum in that market, and similar sorts of comments if you look at Hong Kong, the Hang Seng actually looking weaker than China's Shanghai Comp, but same sort of point. It's not doing what the US is doing. It's not breaking out to the upside. Equally Australia and so on. So if you look beyond the US shores, it's not quite as straightforward. The message is not the same as what you see as if you look at the US equity indices, the S&P 500 and the NASDAQ 100. So it leaves us the key question if you're a 1 to 2 week swing trader. Is the US leading the way such that non-US equities are going to break out to the upside? Or is it the non-US equities? Is that the correct message we should be taking from global market price action, where the currencies are stronger and the markets are range bound? Is that the leadership in the global stock market? These are the sort of questions we think about in the Rag Trader, the daily rag, each and every day, when it's published at 9 a.m., roughly 9 a.m. London time, with a 1 to 2 week outlook on equity index futures, typically S&P 500, based upon our market timing models, both short and medium term, and our interpretation of the market, and our analysis of key questions like that one I've just posed. If you're interested in a free trial, please click on the link below. All we need is your name and email address, no credit card details required, and we'll give you a free trial of the Daily Rag. Or if you're a subscriber, it'll be in your inbox around 8:30 a.m., 9 a.m. London time, each and every morning. So what are we watching this week? Well, three key themes. Firstly, US earnings. They kicked off in earnest on Friday last week with some of the major banks. They continue this week. Lots of companies reporting earnings, including the likes of Tesla, Bank of America, Netflix, amongst many others. Second key theme is that of inflation. More inflation from around the world. We've got the latest in the UK and the latest in Japan. Both of those are really critical. Japan, of course, because what is it going to do with its yield curve control? Is it going to lift the target rate for 10-year bond yields or not? Inflation's a massively important ingredient in that equation. And then the UK is important because inflation seems much stickier here than elsewhere. So what will this next print tell us about the path of UK inflation? Is Andrew Bailey, the governor, right? Or actually is it not nearly as sticky as it seems, as we were perhaps suggesting in our latest long view from London, written last Friday, published on Substack? And then the third key theme that we'll be talking about and watching and monitoring is all the data coming out of the States. The real key data points out of the US this week, including retail sales and the Conference Board's leading economic indicators, as well as one or two bits and pieces of US housing data. So that's it from us. That's your morning market hit for Monday, 17th of July. Thank you for listening. Please do subscribe to these videos on YouTube. Simply click on the subscribe button or follow us on LinkedIn, Twitter, and/or Facebook. Thank you for listening. Stay safe. Trade well.